Hey everyone, if you're new to investing, it can feel overwhelming. But don't worry. Today I'm breaking down 4 key investing concepts every beginner needs to know. These are the must-know fundamentals that will help you make smart financial decisions and grow your money over time. Plus, I'll explain them in a way that makes sense, even if you've never invested a dollar before. Let's get into it. Number 1, compound interest, your best friend. The first concept is compound interest. And trust me, this one is a game changer. It's the reason why investing early is so powerful. Imagine this. You invest $1,000 at a 10% annual return. After 1 year, you have $1,100. But in year 2, you earn 10% not just on your initial $1,000, but on $1,100, giving you $1,210. Over time, this growth snowballs, and after 30 years, your $1,000 could grow to over $17,000 without you adding another cent. That's why starting early, even with a small amount, is crucial. The longer your money has to grow, the more powerful compound interest becomes. Let's take an even crazier example. If you invest just $200 a month starting at age 25, by the time you're 65, you could have over $500,000, assuming a 7 to 8% return per year. But if you wait until 35 to start, you might only have half that amount. Time is money, literally. Key takeaway: the best time to start investing was yesterday. The second best day? Today. Risk versus reward. Know your comfort level. Next up, understanding risk and reward. Every investment carries some level of risk, and typically higher returns come with higher risk. Low-risk investments like bonds, CDs, certificates of deposit, and high-yield savings accounts provide stability but lower returns. Medium-risk investments like index funds, ETFs, and blue-chip stocks balance growth and safety. High-risk investments like individual stocks, cryptocurrencies, and option trading have higher potential returns, but can be very volatile. A great way to gauge your risk tolerance is to ask yourself, would I be okay seeing my investment drop by 20% in a year? If the answer is no, you might want to stick with lower risk options. But don't let fear keep you from investing. Historically, the stock market has gone up over time. Even with crashes and corrections, a well-diversified portfolio has always rebounded and grown in the long run. Higher risk can mean higher reward, but only invest in what lets you sleep at night. Number 3, diversification. Don't put all your eggs in one basket. Imagine betting all your money on one horse. It's risky. Investing works the same way. Diversification means spreading your investment across different assets to reduce risk. Instead of investing only in one stock, consider a mix of stocks, bonds, real estate, and even different industries. If one investment performs poorly, others might perform well and balance things out. For example, let's say you invest in only tech stocks and a huge tech crash happens, like in the early 2000s. Your entire portfolio could be wiped out. But if you also had investments in healthcare, consumer goods, and bonds, your losses might be cushioned by gains in other areas. A great way to diversify without stress? Index funds. They give you exposure to hundreds of companies in one simple investment. The S&P 500, for example, tracks 500 of the biggest U.S. companies, giving you instant diversification. The more places your money is invested, the less likely you are to lose everything in a downturn. Number 4, time in the market beats timing the market. A lot of people try to time the market, buying stocks at the lowest price and selling at the highest. But here's the truth. Even experts struggle to do this consistently. Many beginners think they need to jump in and out of stocks, but missing just a few of the market's best days can seriously hurt your returns. Studies show that if you missed the 10 best days in the stock market over 20 years, your returns could be cut in half. That's huge. So what should you do? Stay invested for the long run. The stock market has always had ups and downs, but historically, it has gone up over time. If you stay in the market instead of jumping in and out, you benefit from long-term growth and compound interest. Example, if you invested $10,000 in the S&P 500 in 1980 and just left it alone, it would be worth over $1 million today. That's the power of staying invested. Time in the market is more important than trying to predict the perfect time to invest. Those are 4 key investing concepts every beginner should know. Master these and you'll be way ahead of the game. If you found this helpful, drop a like, hit subscribe, and let me know in the comments. What investing topic do you want me to cover next? Thanks for watching, and I'll see you in the next one.